Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. And today we're going to be fielding a client question, right? We've got this question a lot, so we figured to make a video about it. But really the question is, how can I make my banking system bigger? Anthony, how many times do you think you've gotten that question?
Quite a bit, right?
Yeah.
Quite a bit. Because a lot of times when the people read the book, right, and then they start practicing it, a lot of people have the goals like Nelson had talked about, of increasing your banking system.
Mm-hmm.
And so the big question is, how do we do that without changing your cash flow?
Exactly. Oh, great.
You like that?
That was good. So Anthony, when you pose that question, what are some ideas that you share with somebody?
Well, first thing I want to ask is, are you expecting any increase in your cash flow? And
When you say increasing cash flow, what do you mean by that?
what I mean is that can be quite a few things. Maybe you have a debt or a car that's about to be paid off, right? Or maybe you're expecting a raise. Maybe you're expecting a bonus.
Okay.
Maybe you have a sale of an asset coming, right? Or maybe you're going to sell your business at some point. Like, do we have the ability where we're going to have extra cash? And one thing I would say that this is more for somebody who's confident in the infinite banking concept is with inflation alone, your income's going to increase, right? Your premiums are set. They're going to stay the same. But as inflation hits, every income and wages and everything is going to go up. So you're going to have money just simply from inflation. So if you believe and have that abundant mindset that your cash flow is going to increase, okay, and you have loans outstanding that you're making loan repayments back. So one thing to remember is a loan repayment just fills your policy back up, right? We borrowed against it, and then a loan repayment fills it back up. It's not making it bigger. The only thing that's going to make your banking system bigger is going to be premium payments. So one option is if we're making that premium or that loan repayment, we may just reallocate that to a premium payment, right? It's still in your banking system, right? But it's making it bigger as opposed to filling it up. And some things in there. Okay, so let's say you got some extra money. The first thing I do like to do is there any room in your current policy? Right? A lot of the times when we design it, it's right up there against the MEC line, meaning there's no more room for extra deposits. But sometimes, depending how you want it designed, we've been designing some with some extra room. So maybe we could easily just add those to some PUAs. Another thing is, those PUAs are optional, which I call the want to, right? If you want to pay them, you can. And if you don't, you don't. But depending on the companies, some companies allow you to go back and pay the PUAs that you missed. So that might be a really easy way to do that. But if we've maximized that, then you know what? Another thing to look at is maybe now it's time to open up another policy. Like I know for me, I know my income is going to go up, whether it's just my cash flow or a sale of an asset or an inheritance, or I know I feel confident that my income is going to go. So I'm intentionally leaving some policy loans on some of my policies, and this is allowing me to start new policies. So when I get that windfall, as opposed to starting a new policy, say 2 years from now, I'm able to start a policy 2 years prior. So, and the advantage to that is, with these policies, it takes some time to get mature, right? And these policies are designed to get better and better each year. And the thing is, the toughest years are the first couple, right? There's no way to avoid that, right? And so, Cameron, what are the best years of the policy?
The latter end of the policy.
Right. Yeah. So by delaying the start of a policy later, we're still going to have that slow start at the beginning. But what we are giving up are the two best years. So by the advantage of starting it 2 years early, we start that compounding now, and we're going to be able to get the 2 best years of the policy.
Awesome. Great insight, Anthony. And then have you ever had anybody kind of ask you questions about maybe redirecting dollars that were going to alternate accounts?
Yeah. So one thing we're looking at is, where's your cash flow going? And, we're really big on following your goals.
Mm-hmm.
Really, like what we wanted. And that's why when we first meet with somebody, the first thing we do is ask them, what are your goals? What are you trying to accomplish? And then the reason why we do that, because if we lay that out, we're bound to get in a fork in the road. Do I do A or do I B? You don't know which path to do. So by focusing on your goals and knowing what your goals are, then you can go back to your goals and say, okay, which path here is going to help me achieve my goals? Okay, so that's one thing that we're looking at. So what you can look at is, are there any places where I'm putting my money that are not getting me to my goals faster?
Absolutely. And if you're finished on that one, I'm going to bring up the mortgages, right? We often have clients that come to us when we're talking about redirecting money, is they also bring up the idea of, hey, I'm paying a little extra on our mortgage. Is that a good idea or a bad idea?
Mm-hmm. Okay. Well, I would say paying off your mortgage, I say it's never a bad idea.
Mm-hmm.
Okay. But rarely is it the best idea. And so, but really, and Cameron, maybe you can kind of play as a client. Why do most people pay down that? Why are they paying that extra $100 or $200 a month towards their mortgage?
Because they're looking at getting their house paid off as soon as possible.
Right. But then why? Like, why do they want their house paid off?
They want freedom, right? They want that, they want to be free from that mortgage payment every single month.
Right. And so, and I totally get it, right? Your mortgage payment is probably one of the biggest checks you're writing each month. Okay. So we want to stop that payment.
Mm-hmm.
Right. But we kind of need to look, we talk a lot about opportunity costs, right? We only have so much money. So if you do A, you can't do B. Thus, if you pay down your mortgage, you're not going to have that liquidity to do something else. Right. And a few things, I always ask when you're deciding about, paying down your mortgage, particularly if you're only paying like a couple hundred or a couple thousand a month, right? Is your monthly payment, is your cash flow going to increase by making an extra $100 a month? Are they going to recast your loan and lower your payment?
The answer is no, they won't change their cash flow.
Right. So we're not changing our cash flow by doing it. Are we lowering our taxes? I would definitely say no, right? Because maybe we're paying a little bit less interest, which means there's less deductions there. And also that interest, especially now, is super low. Like, I would not be in a hurry to pay off that mortgage. But then also, what happens if an opportunity comes, right? Maybe that opportunity, hopefully it's something positive, like maybe a business opportunity, or maybe the opportunity is like you need a new roof, right? Or some sort of major expense. If you want to get that extra money that you put back, you're going to have to ask permission to get access to it. And one thing we've talked about is like banks are like your neighbor who will say, who will loan you an umbrella when it's sunny out. But the minute it starts raining, there's that knock on the door. Hey neighbor, that umbrella that I loaned you, I need it back. And you're like, well, it's raining. They're like, I know. That's why I need it back. Right. But they only want to loan you money when you don't need it. And a lot of times these opportunities, maybe there's a job loss or something going on and you're not going to qualify. I do want to give credit for that scenario was by Patrick Donho. I want to make sure that he gets credit for that little analogy. So by paying that money, we're not changing our cash flow, right? We're not saving in taxes, and we can't get it again, right? And then it goes back to, what are your goals? And really, if maybe one of your goals is to pay off the mortgage, and then you should, right? But for most people, most of our listeners, we're trying to create that passive income, right? So maybe that money could be better used allowing us to create some more passive income.
Anthony, awesome. Thanks for that insight. And then another scenario that we come across often is if someone is contributing up to the max, or if they're contributing just up to the max in regards to their 401k contributions. Anthony, what insight do you have for us there?
Again, I would say it's going back to your goals, right? We're in a path in the road, right? Should we put money in a 401k, or should we put it in a policy or somewhere else? What's your goals? If your goal is to create passive income, can you do that inside a 401k? Is that going to help you achieve financial freedom? If that's not part of your goals, then stop putting money in places that are not going to help you achieve your goals.
Awesome.
Well, and then the question is, well, what if I get an employer match?
Mm-hmm.
And so personally, I'm okay if you want to do at least to the employer's match.
Mm-hmm.
Rarely would I recommend that you do something different.
Yep, absolutely. Anthony, great insight. How many times have you, or let me state this way, let's give these guys a practical example of ways in which maybe business owners have increased their banking system over the years.
Well, one strategy that we will do is we will run their taxes through the policy, right? Because with most business owners, they're going to have to pay the estimated tax. Maybe they're doing it every quarter,
mm-hmm.
right? Where's that money sitting in between there, right? And really, you got to look at the interest and the penalties that the IRS charges for not paying quarterly are actually pretty small, right? So it is not a deterrent. So one strategy that we do is we're show business owners how they can run their taxes through a policy. We're not going to go into that now. This demands like a separate podcast, where we can dive deeper in that. So be on the lookout for that.
Yeah, we'll do a podcast and maybe we'll even do a video along with that
Mm-hmm.
one. Awesome. All right, perfect. Anthony, what about maybe repositioning assets, right? These last couple of years, there's been some pretty unprecedented opportunities for a lot of people. You mind sharing with some of those with our listeners?
Yeah. Again, what a lot of people have, a lot of times people come to us, like their assets are mainly inside a qualified plan, which is like an IRA, 401k, or a SEP, right? And sometimes they want to use that money to put it into a policy so they can start like using it today as opposed to waiting until they're 59 and a half,
mm-hmm.
right? Now, last year, I would call it a dream law, right? Like a wish granted, that with the CARES Act, they had allowed you to take out up to $100,000 from the 401k or IRA with no penalty. You got to pay the tax, but you got to pay the tax anyways. It's just whether you're going to pay it now or do you want to pay it when you're in retirement, right? Then it goes down. Tax is going to go up or down. But what I would say with the CARES Act, so no penalty, and this was pretty cool. You could spread the taxes over 3 years, which is a great way to be able to take that money out. Unfortunately, the CARES Act expired at the end of 2020, but fortunately, Trump's last bill, you may have talked about, it was only $900 billion,
mm-hmm.
right?
Yeah.
And in part of that, in essence, it extended the ability to take the $100,000 out, and you can still spread it out over 3 years. But what's different, it was harder to qualify for the CARES Act. But in this act, it's much easier. You know, in essence, the obstacle is you have to had a financial loss, which I think could be pretty easy to overcome.
Easy to qualify, I'd say, across the board for most people.
Like if you had a business, you probably lost a client or a customer because of it. Maybe you had to buy more equipment or change your hours or something. Or also, maybe you have a kid in college or school that Now you had to redirect. Maybe you're working less, or you had to somehow kind of figure out how they're going to do school online. You had to buy a computer or something like it. That barrier is going to be pretty simple to bear. So that is another option of here we're just kind of transferring assets from one account into another account. I will say, Cameron, I am a recovering CPA.
I do know that,
right?
yes.
So we're not giving tax advice, right? But just like anything and everything we have in here, don't take our word for it. We want you to do your own research. We want you to be financially independent, not just financially or dollar-wise, but more importantly, sense, as in common sense.
Anthony, great suggestions, and we appreciate you being on the hot seat for these questions today. You did a great job of answering or identifying opportunities for our clients to redirect maybe some money on a cash flow basis, but then also you gave them an opportunity to redirect some assets as well. So great job.
Cameron, did you just give me a compliment?
I did. I probably might have given you two there. Yeah, exactly.
Or take it. Thank you.
Absolutely. Hope you guys enjoy this episode.
Make it a fantastic day.
Take care.